Well, here on the heels of Halloween, I thought I would mix it up a little bit, give you three things that scare me going forward. Now, I'm not pessimistic, but I feel like if this great run of ours comes to an end, that we'll be able to look back at one or two of these three things I'm about to walk you through and see what was to blame. Number one is inflation. Now, central bankers around the globe are acknowledging that inflation is a little stickier than expected. You keep hearing this term transient, meaning temporary. But how much of this is truly temporary? Maybe some of this supply chain logjam, maybe some of the materials prices or energy prices. But what about wages? In fact, the number one driver of inflation is wages. How much of this wage rise in wages do you think is temporary? Who do you know that's been hired on in the last 6 months or a year at $15 an hour at a Chipotle or a Chick-fil-A or a warehouse, who's going to be interested in dropping down to $12 an hour 6 months or a year from now? Yeah, that's what I thought. I'm not sure how much of this is truly temporary or transient. Consensus expectation among economists is that inflation, we're at about 5.4% now, that will drop to 3.3% by the end of next year, and then 2.3% in 2023. Many consumers, however, not so sure. The wild card is the supply chain. These disruptions, of course, a major part of the supply and demand issues that are pushing prices higher. If disruptions linger or worsen, well, Wall Street's not going to like that. Number two, an aggressive Fed. The Federal Reserve is expected to fully end its bond buying program by the middle of next year, 2022, with interest rate hikes. The wild card, however, is how sticky inflation will be throughout 2022. Now, maybe current inflationary pressures will recede over the next 6 to 12 months. If, though, inflation is stickier and the Fed is forced to aggressively taper and hike rates, think back to Jimmy Carter era, if they're forced into speeding up that tapering or aggressively hiking short-term interest rates, well, Wall Street's not going to like that. And number three is profit margin pressure. Now, you've heard me say 1,000 times, if I've said it once, markets trade on what? Profits. That's right. Third quarter profits, earnings, have been very solid. In fact, 82% of the S&P 500 has exceeded already lofty, honestly, earnings targets. The wild card, however, is whether those profit margins can stay this healthy. We're already at above, actually, the pre-pandemic highs, which of course carries downside risk. With labor issues, in fact, we have 10.4 million job openings, and that's 3 million higher than before the pandemic. With shortages of materials, with rising transportation costs and higher taxes and vaccine mandates bearing down on us. Who even knows how that's going to affect or complicate things? If any of those things, or two of those things, three of those things significantly eat into profits, well, Wall Street's not going to like that. So maybe three things that scare me was a little sensational. I'm still positive near term for the market outlook. The reopen math is strong. It's driving economic growth. COVID, 19 cases in decline. Vaccinations, of course, helping. Stimulus on the way. A Federal Reserve that's supportive. Low interest rates remaining. Still positive. But as we look at those yellow flags or cautions on the horizon, if there's two or three things that scare me, I think those are the three. That maybe we look back and say, yeah, that's what was to blame. That's it for this month. If I don't see you between now and then, happy Thanksgiving to you and all your family. Hope you have a blessed holiday, and we'll see you next time.